Peter Lides with you. This is Stock Market Cycle's YouTube update for the week ending Friday, May 10th, 2024, being recorded late Sunday night on May 12th, 2024. I wanted to get this update on before the new market week began because we have some important things happening once again. The last update I did was several weeks back. It occurred the night of February 13th, I believe, Tuesday, February 13th. Here's the week ending February 9th right here. And the reason we did the update was this right here. Okay, this chart shows the NDX weekly close, the Dow Jones Industrial Average weekly close, which the chart of that is not too great because we're not interested in it. We're just using it to form a ratio between the NDX and the Dow Jones Industrials. And here's that ratio right here, okay? And we were somewhat excited on the last update because for only the third time in the history of the last 40 years, the NDX was formed back in, I think, 1985, October of 85, anyway, right around that time period, almost 40 years ago. And since the formation of the NDX, the NASDAQ 100 index, if you divided every week since then, 40 years ago, it's that 2,000 something weeks, the NDX at the end of each week by the Dow Jones Industrial Average, you would get a ratio. And I'm going to back up on this chart here just to give you an idea of what an extreme ratio we witnessed back on February 9th. Here we go. It gets a little messy at the end here, but we're going to show you a close-up of that in a minute. This is the ratio, the lower part of the chart here, of the NDX divided by the Dow Jones Industrial Average. And typically it runs around the 10, 11, 12, 15% level. Let me go back in time for you. Follow this line here, the lower line in the chart. Here is the other part we're interested in, right here. In this wild, crazy, most speculative market in history, perhaps aside from the current one, this is what happened in March of 2000. The ratio NDX divided by Dow Jones Industrials went above 46%. The reading on this high week was, you can see it at the bottom of the box in the middle of the screen, 0.462, 46.2%. And you can also see how quickly that reading came down over the next couple of years in a decline of 83.5% on the NDX from this March reading with a very high ratio, the October of 02 bottom, 83.5% down. But for the purposes of this examination, follow the line. I'm going to go forward again. You can see the scale over here on the right, okay? 0.15, 0.25. And you'll see that almost all the way through the years, 2005, 2010, 2015, 16, 17, 18, 19, and look what started to happen in 2020. Mind you, we had gotten nowhere near. I put a red line here. Let me squeeze this up again so you can see the whole thing on the screen. Here it is right here. Here's the red line where the 46% reading took place. When did it happen again? The exact all-time high close in November of 2019. The reading there, let's break this up again. Notice that this has only happened once, twice, 3 times in 40 years. Here's the second time, and we'll break this up. Okay. The week of November 19th, 2021, for only the second time in the history of the 40-year database, it reached a 46% reading. And look where it happened. The exact high closing week before a decline of almost 38% going into October of 2022. But that was it. Then we started this incredible rally again that not only recovered this full loss, but went to a new all time high. And if you followed the ratio came down. But remember, we saw it around 10%, 12, 15%. When it came down to the October low, it only got down to 32.8%. And if you're using it as a valuation tool, that's nowhere near where you would call undervalued. So it got down to 38% and it went through the whole cycle again. Here we go. And this is what happened. 46% week ending February 9th of 24. And that motivated us to do the update we did on YouTube on February 13th, saying that a major warning signal had been issued in the market. You know why we said that? Well, in 2000, the only other two times that happened were followed by a decline of 83.5% and a decline of 37.5%. Well, here we were again, finally, February 9th, the week ending February 9th of this year. So this is how I embellished the chart over the last day or two, okay? This, within these 2 weeks right here is when I did that update, pointing out a closing ratio over 46%. Well, that was 3 months ago. That was February 2024. And we've now gone through 3 full months of market activity, okay? Tomorrow, the 13th, will be exactly 3 months. So you say to me, oh, why, Eddie? Where's your magic signal? Well, I thought the market was supposed to fall apart. Well, the signal doesn't tell you that. If you look at the history of it, what it tells you is, and we've only had 2 prior instances before this reading on February 9th of 24, and it told you that those readings preceded very significant declines in the market. Didn't tell you when they would start, didn't tell you how far they'd go. But based on the short history that we have of them, danger signal. So here's what I did. If you say how impatient you are, and believe me, I'm getting a little impatient myself, because you say, well, when is this signal going to work? If it is, when's it going to start? So what I did was I took each reading above 46%. And remember, before this week, there were only 2 weeks in history. Now we've had this 1, 2, 3, 4, 5, 6, 7, 8 weeks, readings above 46% at the close of the week. What I was curious about was, we know the market hasn't gone down in earnest, but has it gone up to any degree since the first reading was given on February 9th? And the answer is no. N-O, no. Market's gone nowhere to the upside. What I did was I wrote in these little spaces between the weeks what the biggest market move to the upside was subsequently after we got a reading above 46%. Well, from February 9th, which is right here, forward to the present day, the biggest weekly close above this level on February 9th was 2.1%. Okay? So you go forward in time. We had another reading right here, March 1st of 24. Here's where the NDX closed that week. What's the biggest gain that's been made since then on a weekly closing basis? 0.2%. The very next week, as the market started down a little bit, another reading above 46%. What's the biggest gain that's been seen since there on a weekly closing basis? 1.7%. So then we went for 2 more weeks, and again, a reading above 46%. It seems like they were endless, but you didn't keep getting readings above 46% with much higher prices. Look at this pattern here. It's almost completely sideways. The biggest move from this reading, subsequent to a 46% plus reading, 1.7%. Then finally came the week ending March 22nd. That has been the highest weekly close. That's the all-time high weekly close. And of course, if it is, then the biggest weekly close after that in terms of percentage gain is zero. Never got any higher. Another reading above 46% 2 weeks later. Here it is right here. What's the biggest gain on a weekly close that was made since then? 0.3%. Another one from here. Biggest gain going forward? 0.1%. From here, 2.5%, which is from here to this past week's Friday close, and from here, 1.5%. So here's the point of all these numbers and these closing readings above 46%. 46% is the red horizontal line here. So this is the furthest the market moved over this 3-month period after a reading above 46%. What was the largest subsequent weekly close above the week that showed a 46% reading? So the bottom line is we've gone nowhere. Okay. So if this was a great danger signal, and it might still just have been a great danger warning signal, as were all the rest of these vertical red dashed lines, we haven't gone anywhere, neither up nor down. So nothing's been proven yet, okay? If you believe the history of 40 years, you might think to yourself, every single one of these readings is going to end up being a great warning signal in the not too distant future. When you look back at this chart a year, 2, 3, 4 years from now, and see these readings above 46% and see these prices, I have a feeling you're going to say, wow, those readings above 46% worked really well. Okay, now, since I showed you that 46% reading, NDX divided by the Dow Jones Industrial Average, a few weeks later, I discovered another ratio. The reason I came up with it is I said to myself, maybe the NDX isn't the best index to use when we're thinking about the great speculative fervor behind AI, behind artificial intelligence. Probably the best index to look at would be SOX, the Philadelphia Semiconductor Index. Okay. So I said, hey, the computer does all the work. Let's take a look at that ratio. SOX divided by Dow. And when I did, the results were remarkable. Watch this. Okay, I want to give you a broad general overlook so you can look back. You're going back, this is a daily chart that goes back over 10 years. But to give you an idea of how this ratio worked. So let's go back to the time period that most people look back at in terms of how to measure speculative fervor. Okay, that's the year 2000. More specifically, March of 2000. And look at this. Just as might have been expected, all this time, the SOX, I believe, it was devised, I think, in 1994. So you can see this is a ratio of the SOX divided by the Dow Jones Industrial Average. And for the first 4 or 5 years of its existence, it ranged between readings of about 6.5% on the high side and around 2.5% on the low side. So 2.5 down here, 6.5 down here until this happened. This was that speculative craziness that occurred going into the year 2000. Look at how this ratio moved. And finally, let me spread this out a little bit for you. Coming into March of 2000, this crazy move to the upside, this crazy ratio reading on this day. Look at this right here. Don't look at the above chart yet. Look at this right here. On March 10th of 2000, that ratio reached 13.4%. SOX divided by Dow Jones Industrial Average. And as that happened, that crazy reading was registered. Now you can look at the price above. That ended up being the exact closing high in the SOX prior to a decline over the next 2 years of over 80%. So, this is the background to what I looked at, the research I did after I did the NDX research, and thought that perhaps the SOX might even be more important. Okay? So I had this reading, 13.4%, the ratio of SOX to Dow Jones Industrial Average, and follow me here. Okay, this is 2001 in the middle, and 2002, 2003, 4, 5, 6, 7. You can see with the scale on the right, these readings are all around 3, 4, 5%. Okay, now we're into 2007. And even at the market peak in 2007, right up here, okay, July 17th, the ratio was here, 3.8%. How does that compare with the 13.4% seen back in March of 2000? There's no comparison whatsoever. Okay, it's 1/3, 1/4 the size. So we had this big decline in the SOX index and all the other indexes between 2007 and 2009. In the case of the SOX, I believe it bottomed in late '08. Here it is right here, okay? And at that time, the ratio was down to 2%, 2.2%, okay? Compared to 13.4% in March of 2000. So 1/6 the reading. Now let's go forward. Follow me here. I'm not going to take too much time. Just want you to take a look at the ratio. 3%, 4%, 3, 4, 3, 4, 3, 4. Now we're into 2017. It got up to 5. Speculation. Well, nowhere near 13% again. Got up to 6% now. And now we're into 2020. 7% reading. Wow, all of a sudden it's getting interesting. So this is now into 2021 and early 22. Remember, the NDX topped right here, the right side of the chart that I'm showing you. It was November 19th, which is right where the cursor is here. That's where the NDX saw its all-time high at the time. And at that time, look at the ratio, 11%, 10.99% ratio. It got up as high as 11.2%, but nowhere near the 13%. That's way up here. Okay? So you could have made the argument at that time, well, the market's not going to top until we see the kind of ratio we saw in 2000. We did see it on the NDX. We did not see it on the SOX. Well, let's go forward slowly another couple of years and see what happened. Here are the highs seen into November, December of 21, January of 22. And then we started coming down a little bit from that 11.1%. We got down to 9, down to 8, almost down to 7. This was the October 22 low that we saw. Here it is right here. The date on the SOX was October 17th, right here. Okay, and the ratio there was right around 7.3%. Okay, almost half of the excessive speculation ratio that was seen in 2000 of 13.4%. Well, what did the market do from there? Well, it took off again from October of 22. Follow the ratio now. By June of 23, it was up to 11% again. That was the reading that occurred in November of 21, while some indexes were making all-time highs that would last for 2 years. But let's follow this now. 11. Whoa, there we look at this. Now I want you to pay attention to this. See this blip to the upside right here? These two lines represent 13.3 and 13.4%. 13.4, the red line, was what we saw at the crazy March 2000 high. Between that and now, we had never come anywhere near it again until this date right here, March 7th, 2024. And look at the ratio reading. Let me move this over a little bit so you can see it more clearly. Look at the bottom of the box. 13.32%. Almost a perfect match of that March of 2000 reading. Okay? Now, here is the fascinating part. That was the first time we reached a similar reading, and look at the price of the stocks above that. In both cases, 2000, March of 2000, and March of 2024, that 13.3.4 reading in the ratio of stocks to Dow Jones Industrials marked the exact closing high on the SOX index. Now, mind you, this was 2 months ago now. We're talking about March 7th, the exact closing high. And as we're recording this, we're May 12th. So it's beyond 2 months, and we haven't approached that reading again. Okay. Here's one more quick thing that I did. This is back here, just a week or two ago. And we had reached up to, this is an arbitrary reading right here. I marked it down. It's a reading of 12.4%, about a full percent down from this extreme, okay? But I noticed that we played around with that level for a long time, 12.4%. And I was curious to see, once we had a reading of 12.4% after coming down below it, what was the upside potential in the market? It was almost like the thing we did with the NDX and the weekly closes, and what's the furthest it went after we had a reading above 46%. Well, this is a reading of 12.4%, and it's a daily chart now, and I wanted to know what's the best the stocks did after getting back to this kind of reading. And you can see what the answer is here. These are the readings right here. I'll do this vertical cursor where you can see both the upper and the lower chart. And you can see that these readings in the red zone, around 12.4%, corresponded with highs that were, so far at least, have not been returned to. So we saw it again when I got curious about that ratio right here at the end of April. And since then, we came up to it one more time. That occurred right here on May 6th. And here we are as of today. The ratio has gone down even further. So now in the SOX, instead of being near its all-time high, we have a high below a high below a high, and a high below a high. This little intervening one went lower than this one, but now it went this one a little bit higher than that. But we have a high beneath a high beneath a high. Never got close to this real warning signal here. So this is what I would call major warning signal number 2. Right here. This date just so happened. Coincidentally, you say? Just so happened to mark so far the all-time high close in the SOX index. Okay, there's more to go. I was going to go through daily projection charts to show you that on the daily projection chart, the equivalent of a 5-week offset, which in my technique is 24.2 to 27.6 market days, on Friday of this past week gave a significantly higher upside projection. That was on the daily chart. So I got curious and I said, well, I think it has to be confirmed on the weekly charts too. So let's take a look at that. And that's the chart I'm going to show you. Okay, here is a weekly projection chart for the S&P 500 cash index. This is the shortest offset we use on the weekly charts, 2.5 week offset. Okay, gave this projection on the way down, and then we'll show you in a second, it gave a further one to the downside. And as we started up, we want to put this shortest offset on 2.5 weeks, and look at this. As of last week, we came right into the heart of that projection window. Okay, the window called for a projection between 52.12.41 rounded off and 52.69.93 rounded off. The high for the week, this is the midpoint of the projection. Almost reach it perfectly. The high point for the week on the S&P, 52.39.66. Compare that to these high and low projections in the box, okay? So we met the upside projection, and once you meet an upside projection, you go to the next longer offset to see if the meeting of this projection created a higher projection. Mind you, on the daily charts, just by a smidgen, on Friday, it did. It gave an upside projection for the next longer offset. But let me show you the weekly chart. 5-week offset, and look at this. Here's the midpoint, which we call the signal line for the week. It did not get above the offset line of 5 weeks, okay? So that means that no further projection was generated. Now, this coming week is very, very important because all you need is a sideways week here. Okay, here's the signal line, the midpoint between the high and low for the week. If that just goes sideways next week, you're obviously going to be above this line, okay? And you will give a significantly higher projection. Let me tell you why I don't think that's going to happen. And this is a thing of beauty. There are a lot of ways that we as analysts, particularly cycle analysts, look at cycles, okay? A lot of people will look for the measurement between tops or between bottoms, and I indeed do that same thing. But there's another thing that I didn't first believe in that became a believer in it after seeing it work so many times. And that's what we call, or what I call, a turning point pattern. It could be a high or a low, as long as there is an almost exact repetitive pattern there, you pay attention to it. Well, look what I came up with here. This is a daily closing price chart of the S&P 500, okay? Now, let me take the end of it off the screen there. Most of you have seen it already, but when I first played with this pattern, and it was just within the past couple of weeks, I initially had put it down as a 196 trading day pattern, okay? And it was due to resolve on Thursday of this past week. But when we went a little bit higher at the close on Friday for the S&P, and you can see that result right here. This is Friday's result, up 8.6 points, or 0.16% on the S&P cash index. And I said, well, because I wanted it to be exact. It doesn't have to be. You could be within one or two, you could do a plus or minus 1 or 2 days, and that's still a pretty damn good pattern that you'd have there. But this thing was such a beauty that I looked at it and said, my goodness, look at this, and look at it. Let's start from here. We won't look at this first part of the pattern, and I'm going to spread these out a little bit. So we'll keep, although you may have seen it already, we'll keep the surprises for the end. On this day right here, and this day happens to be January 3rd, 2022, the S&P 500 cash index closed at an all-time high right here, okay? Now, if you follow that forward, there are a section of 3 lows you can choose here. This one is October, make that September 30th, right here. This low is October 12th, and the third one, which is the one I use, was October 14th. And if you measure from this all-time high, make it visible again over here, this all-time high down to this low, and click on the red line, and it says 197 trading days, okay? That's the spacing. Let's go forward another 197 and see if we see anything interesting that occurred. It'll be the next red vertical line. And there it is. See it on the extreme right side of the screen? Now, if you had just started to keep track of this pattern, you would find it mildly interesting here and say, well, from this high over here to this low down here, was 197 trading days, and we've now gone 197 into this one. Let's take a look and see what happened after that. It's a little more interesting. Well, now it's a lot more interesting. Wow. And look at this. Into October of 2023, you had this decline from this exact closing high. Okay. So now you have 1, 2, and the all-time high in Jan of 22 resolutions of that cycle. And where does that take you in the current time zone? Bingo! Friday, May 10th, 2024. Here it is right there. Okay. Now, I'm just going to take a little more time here because this one worked out so well. I said, well, wouldn't it be nice if we went back a little bit before the January of 22 high and see if we had any other turning points? So I did that, and look at this, lo and behold. Now, this was not the kind of low that you came way down into, but this is the kind of low that we never closed lower than again, at least over the next year or two. This was a perfect low that led to this advance to the all-time high. Let's go back one more and take a look. Oh, look at this. Wow. Again, a perfect low, never went lower than that for at least the next few years, right here. And there you go, leading up to this kind of sideways move into the next low. So now we have 1, 2, 3, 4, 5, perfect one up here. And the last one, we have to put a question mark up, okay? So there is a strong potential expectation that this could be a turning point. I have to tell you the truth. I've looked at a lot of turning points in my life, and there's 2 lessons you learn from them. Right around the time you discover them, they stop working. That may happen here. There are no assurances. But also, eventually, obviously, they will stop working. If they didn't, then people would have discovered a lot of these a lot longer ago than the present time, okay? But isn't this a thing of beauty? I must say, in over 50 years of market analysis, particularly cycle analysis, I don't think I've seen one this consistent. Exactly, bingo, exact on the closing highs and lows. And I'll leave you with this. This is where we closed on Friday on the S&P 500. Now, it's important that we turn down from here because any kind of even just a sideways week next week will confirm the much higher projections on the S&P weekly projection chart. There are so many reasons for thinking that's not going to happen, and I've shown you several of them in this update. The first one related to those ratios of both NDX to the Dow and SOX to the Dow. They seem to be telling us that the upside potential with these ratio readings, and remember it closed above 46% again this week on the NDX ratio to the Dow. The maximum upside potential has been a couple of percent since that happened. And not only since that happened, but 40 years of experience, 40 years of data. Okay, so those are the major warning signals that are out there. Obviously, there was one given almost 3 months ago, February 2024. And we did this. We had a nice little decline, but that's not the type of decline that this type of reading of 46% is hinting at, okay? You saw the last two, one of them almost 40%, and the other one over 80% from 2000 to 2002. And with that, I'll leave you. There are a lot of things to talk about, but I think I've shown you enough to give you reason to be cautious here and to be looking for the possibility of something very different and perhaps very unexpected happening to the downside. I'm Peter Eliades. I would encourage you, first of all, to subscribe to this YouTube service, which is completely free. We used to do updates almost every month at least, and we haven't done them with that frequency of late. But when I think that I have something really important to say, we'll go on YouTube and let people know what that important thing is. And I think this update is potentially very, very important. So I'd ask you become subscribers. Number two, I'd ask you to go to the website, stockmarketcycles.com. We offer a free trial of daily updates that work with this kind of material every single market day. 2 week, I think it's 2 week or 14-day, completely free trial of the daily service. So you'll get 10 free video updates on a daily basis to see if you like it. It might be helpful for you. Okay. So go to the website, stockmarketcycles.com. Go to, I think it's the register is the pull down menu. Go there and you'll see the free offers being made. And that's going to be it. Thanks a lot for watching. We're in a fascinating position in the stock market. We'll talk to you soon.